If you're someone who just wants to buy and hold, it makes sense to buy 10 companies that you know very well and you just hold them for life or until the fundamentals maybe start to change.
I also make sure within my stocks that I have in my portfolio, I have some diversification into more boring stocks that are also fundamentally good, but with less volatile spikes.
The risk level that you're going to take with $1,000 in your trading account is going to be very different than an account that's $1 million or $10 million or $100 million, right? So that's something that people have to start incorporating in the way that they think. And it's kind of, okay, am I willing to risk this money? What do I need this money for? Welcome to the Market Buzz Deep Dive. Ever wonder how a solid long-term portfolio is built? In this episode, we'll reveal how top investors allocate risk, capital, and plan for long-term growth, ensuring investment can weather any storm. Make sure you stay for the whole episode because we're going to be breaking down risk analysis, we're going to be breaking down position sizing, and how we trade our own portfolios to make you some money. So make sure you watch the whole episode. And don't forget to hit that like and subscribe. All right. So I want to start where everybody starts, How do you grab some money and put it into the stock market? You know what I mean? Because we all are eToro popular investors, but when you first opened, your trading account, it's like, okay, like I can buy thousands of companies, thousands of assets. I can buy crypto, I can buy Dogecoin, I can buy Nvidia, I can buy the S&P 500. I want to understand how popular investors think about investing. How do you position yourself when it comes to building your portfolio? Because I know that we have very successful portfolios, and I want to know how we manage to do that. So, who wants to start with this? Who wants to start?
Yeah, I can go. Just in my opinion, there's no one way to succeed in the markets. Like there's not one optimal portfolio allocation. You can succeed with 5 stocks in your portfolio. Even with one single investment, you can succeed, or with 500 stocks in your portfolio, equal weighting or heavy weight on a few names from, these 500. There is not like one way to do it. This is how I see it. So it depends a lot on how you pick your stocks. If you're a guy who's going to read literally everything about a single company, read all the reports, read all the news, you cannot do it with 500 companies in your portfolio, right? So there you need to have a few companies, maybe maximum 10. 10 companies is a lot in your portfolio. I believe I have 13, 14. Today I added the 14th in my portfolio, but not all of them are long-term. So from the 14, I have perhaps 10 that I believe in, and I put more money there and I keep it for the long term. And then 3 or 4 that are either more speculative or more short term, where I do perhaps less research and maybe I read a bit less on that, but the price just looks attractive. And it's, it could be, for example, a very famous company. Let's say if Apple drops by 20% on some stupid news, or like what happened with Nvidia recently with the DeepSeek saga. I'm not reading every single report of Nvidia. There's a lot of information out there, a lot of price targets and everything. But after the DeepSeek news, I immediately bought Nvidia and I made it one of my biggest positions. It's my 4th biggest stock. It's not a stock that I was shareholder for a long time. I was not at all shareholder. I just became shareholder recently because of the huge drop. It dipped to 120 bucks per share. Now I think it's back to 140 or close to 140.
Yeah, market's going to open at 139.40.
Perfect. So sometimes, you make those bets. So it depends how you are as an investor. If you're someone who just wants to buy and hold, it makes sense to buy 10 companies that you know very well and you just hold them for life or until the fundamentals maybe start to change, right? So there's not an optimal portfolio allocation. This is my
Can I
point of
add
view.
something, Akim?
And I think this is how I wanted to start the discussion. But go ahead, Timothy.
Yeah, because I'm not sure what you think about this idea. Like, the more you know about a company, the bigger you bet. for example, a beginner investor who hasn't had a lot of research into different companies, it's better to buy the index because you can just invest blindly in 500 stocks at the same time. There's limited risk. But once you get more experience, once you research the companies a bit better, and once you are really convinced in the fundamentals for the long term, you can bet big. I've seen popular investors allocate more than 20% into one stock. Okay, so it's perfectly possible. But yeah, like for myself, I've always said I'm not gonna allocate more than 10% for one stock, just to have enough options in the portfolio. And the more speculative it gets, so like for example, if you go into a small cap stock or even an altcoin, I try to stay below 5% because one, it's more risky, and two, it's more volatile. The swings are a bit wilder, and especially if you're starting out, it's hard to endure in the beginning.
Yeah, one thing that like, and I recommend this to many investors, right? Is understand what sort of risk level you're willing to take, right? Like the risk level that you're gonna take with $1,000 in your trading account is gonna be very different than an account that's $1 million or $10 million or $100 million, right? So that's something that people have to start incorporating in the way that they think, and it's kind of okay. Am I willing to risk this money? What do I need this money for? Which is the reason I tell people is like, okay, like you should have an emergency fund set aside before you start investing, because the market, there is risk. The moment you grab money and you put it into a stock, you don't know what you don't know. And that's the reality of investing. You can do your research, do your analysis, and the reason a little bit of diversification is always good is because it's a hedge against, like Warren Buffett says, it's a hedge against stupidity. You know what I mean? So it's because we don't know everything that is happening. For example, something like the DeepSeek saga that could ramble markets in such a way. If you were to have 100% of your portfolio, you're more likely to panic and freak out. So that's something we got to take into consideration is position sizing, but also portfolio size, right? Because if you only have $1,000 and it's your first $1,000, I'm okay with you going in one company with $1,000. And as that continues to grow, maybe start diversifying into other companies, other stuff. For me, for example, I used to be a guy that didn't go more than 5% in an investment. But all of a sudden, right, because that allows me to play the whole table, right? I'm playing many different companies that I'm paying attention to. And then all of a sudden you think, okay, what can I do in this case? Okay, Nvidia all of a sudden became a 5% to all of a sudden 50% of my portfolio. So what do I have to do in that case? It's like I still believe in the company. I'm still gonna want to have exposure to that company, but I downsize. And right now it's sitting around 20%, right? But companies like this, having that broad base allows you to then come in and say, okay, maybe this company might outperform this one or this one. But I agree with you, Akim. It's the fact that if you're new to the markets and you don't have time to pay attention, because what we do takes a lot of research, time, and understanding of the market. You know, I've been trading for over 5 years, like investing for over 5 years, overall started investing more than a decade, so it's like, it takes time to understand how the market behaves, how the volume comes in and out of a stock. This is something that is not easy. If stock picking was easy, everybody would be a millionaire, So
Yeah.
that's why if you don't have time, many people say, hey, buy the S&P 500, buy the NASDAQ if you want a little bit more risk, because you don't have to pay attention because you're betting on the whole market doing well. And that's okay. That's also a strategy that we have to take into consideration. So definitely something I want to touch, like I want to emphasize in this case is like I agree with Akim in investing. Whoever tells you that there's one side that fits all wants to steal your money. So don't do that. Everybody's different. Everybody has different rules, different objectives, and you have to understand that. As long as you understand that, you can make a lot of money in the markets, and the way that you look at one stock might not be the same risk appetite or level that
Yes.
other people do.
You used really an interesting wording here. You used the words risk appetite. As we discussed, there's not one way to do it, but you as a person, you have one optimal way that you need to find. And to find your optimal way to invest, you need to understand yourself. And understanding yourself is also understanding your risk appetite, but also your risk tolerance, right? And also your risk capacity. So how much can you lose in the money you invest? You need to start from there. How much can you lose? Unfortunately, it sounds a little bit negative, but you need to be aware how much you're willing to risk. If you invest in crypto, you know that, even if you diversify in a bunch of cryptos, you could be down 90%. Even if you own 100 different cryptos, right? You're not really diversified because they follow similar movements. With stock, the story is different. If you're investing in the 11 sectors of the stock market, and you have, I don't know, the leaders of each sector, and then maybe the front runner of every sector, that's like 22 stocks. You're quite diversified, and probably you're not going to drop more than 30% in a very bad year. So you need to think also in these terms. The upside is also much different in crypto. You could do times 3, times 5, right? Your portfolio. While in those stocks, maybe in a good year, you do 20, 30% return. So you need to think about yourself. What do you need the money for? Is this money to be invested for the next 40 years for retirement? Or is this money more like casino money, right? If it's casino money and money that you really don't count on, and you're happy with your job, you have savings, you have guaranteed retirement, it makes sense to speculate with the money and, try to get rich quick. That makes sense. It's not something that I advocate for in any case, but it makes sense. So you need to understand yourself. This has to be the starting point. So in my case, I like to define myself as a macro investor. I try to see what I know and what my life experience is. So you need to reflect about yourself. In my case, I have maybe a similar story to Nestor. It's not the same countries where we lived, but I lived in several different countries, in Russia, in the US, in Morocco, Luxembourg. So I have kind of this view, I guess some kind of macro view. My family is also very mixed, where I understand what companies work in Morocco, what kind of companies work in the US, what kind of companies work in Russia, what consumers expect here and there and there. I worked also in different industries before working in investment funds. And so that allows me to have some kind of maybe a holistic view, a more macro view, and perhaps a bit less focused on the individual businesses like the traditional stock picker, right? So my way of creating my portfolio and keeping my portfolio is, I think, in terms of macro, which sectors will benefit the most this year from, a range of factors, interest rates and monetary and geopolitical relations, right? So I try to think in this way, and I'm like, okay, this year is going to be good for, in my opinion, good for crypto, is going to be good for AI infrastructure, and is also going to be good for fighting obesity, right? I think obesity is a big problem in a lot of countries. So I try to think in terms of this, which sectors will perform, and then in the respective sectors, I try to pick the best players, depending on a number of things, on their products or on their finances. In terms of crypto, on the projects, on the number of users using those cryptos on daily basis. So this is how I structure it, but that's because I understand who I am and myself, and I reflected on, on my past life, let's say, right? So you need to think about yourself, how you define yourself. This is how I see it. But for Timothy, I think it tells a lot that he's investing in both Microsoft and Dogecoin. That tells a lot about his personality.
I
What
want to
does
know.
that
So
tell you?
How do you justify that?
Well, one way or another, but it's tech. So my portfolio, as I am, is a bit more heavy into tech, and you'll find companies like the classic MAGA stocks, Google, Microsoft, Nvidia, Amazon, Facebook. And I also make sure within my stocks that I have in my portfolio, I have some diversification into more boring stocks like Louis Vuitton, stocks that are also fundamentally good, but with less volatile spikes. I'm not sure if I have it anymore in my portfolio because it switches a lot, but like PepsiCo, for example, are stocks I love. These companies, they will grow, but not grow 40% a year. They might grow 10% a year and could be more recession proof if a recession happens. You know what I mean, Akim? Like you're trying
Absolutely.
to predict maybe a bit with your portfolio the macro. I will have certain sectors in my portfolio 100% locked in case there's something that happens. You know, if suddenly a recession happens, I have these defensive stocks. If not, it will be the tech stocks that lift the other stocks higher. And then I have crypto, which I try to limit to 20 to 25% in my portfolio. I try not to go beyond that percentage because I think investing in stocks, for me, investing in stocks is long term. My stop loss is the financial balance sheet. But that means if the company is having poor earnings consistently, the fundamentals might be changing. But for crypto, I will cut loss if I see the trend is weakening or even turning into a downtrend. And since altcoins can drop 90% and then another 90% and then another 90%, you have to be sure, like, you have to get out before it's too late, or otherwise you're just a bag holder for 4 years.
Yeah, there's definitely, I think, investments or asset classes in which if it comes down, you buy more because you know that the foundation is solid. And there are other asset classes that you run. Or there are even other asset classes that you assume you have lost the money because and this takes me to our next part, our next topic, our next segment, which is risk, understanding risk and how you analyze risk in every single position that you're taking, right? For example, my father says this, one of his big sayings: risk is where two variables meet, the probability of something happening and the damage that it can create. Okay? So if we have high probability of something happening, but you're going to lose $1, who cares? You know? But if we have, in that case, the probability is, the risk is low because the damage cannot be bad. But if you have $1,000,000 and the probability you lose it is 100%, that is the highest risk you can have. So thinking like this is always what has allowed me to kind of take into consideration is like, the way that I diversify my portfolio and I break it down is like, okay, I have a long-term allocation of the companies that I truly believe in 5 to 10 years, they will continue to be here. Worst case scenario, they grow very slowly. That is big. I leave that on the side. That is probably around 70% of my portfolio. Then I have companies that I really like, and in the moment, they are hot. I feel that they're going to change the world. Nvidia, I keep coming back to this beautiful, like the best employee I've ever had is Jensen, because when you buy a stock, you're buying a company and you're the owner. The CEO works for you, but then you put money heavy into those companies, into your first choice. You know what I mean? The companies that you truly believe in. That is like around maybe 10, 20%. And then I leave always 10% of cash reserves where I'm like, I'm waiting for the opportunity for Intel to drop to 17. And then Intel drops. You buy the stock, you snipe because you know that the stock has just been punished because of bad news, but not because of the fundamentals. And that's why the research helps too. So I want to understand, how do you look at risk? What is the thing that you pay attention to whenever you're looking to place a position? It's a tricky one. It's a tricky one.
Tricky one.
It is.
It's a tricky one.
Everything is different because you cannot quantify. Like, it's not like, in this company, I have high conviction. But why do you have high conviction? The same conviction you have on Nvidia might not be the same conviction that you have on Amazon.
Absolutely.
So it's very hard to quantify. But creating those parameters, and the more you invest, the easier it becomes. But for example, in my short-term portfolio, in that 20 to 10% of my portfolio that I was talking about, my short-term trading, I tend to have a breakdown. So for me, that breakdown is usually, if I have an extreme high conviction on a stock, I will put 25% of my portfolio on that one stock. I will go all in on that move. But if I have very low conviction, like buying some, maybe like Mara, like a slow conviction trade, I will go maybe 1% to 2%, because the upside might be higher, but the risk is also higher. So I tend to go smaller. So cryptocurrencies, I tend to go small. I think Mara is the only Bitcoin position that I have on my eToro portfolio, and that's very small because I'm like, I think Bitcoin is gonna do great, but I have no idea. So I'm gonna bet on it, and if it worst case scenario, the gains from Nvidia will pay for my mistake. So
Yeah.
something to consider.
Yeah. So the way maybe I can take it. So the way that I try to assess risk. So I don't use your father's equation, which
My
is,
papa.
in my opinion, is a really good one. But I look at it a little bit differently. When there's a company that I find interesting, maybe I heard about it on TV or I read about it. I try to see the financials of the company from like as far back in history you can get to, right? And if you can see that consistently the company is growing, and also then you look at the forecast and consistently the company is expected to grow, the risk is already lower, but it's not sufficient. You need to look at that, but you also need to look at the valuation. So if the stock is cheap, or at least in line with historical valuation, in my opinion the risk is moderate. There's always a risk, there could always be something happening, like something unexpected, but this is true for any investment. There's always something unexpected that can happen, so I have to carve out this unexpected because I cannot really quantify this unexpected. So I look at the price at which I buy the stock. If the stock is cheap and the financials are good, the company has a lot of cash, in my opinion, the risk is very moderate or low to moderate, right? So there, I don't hesitate to put 5 to 10. I can go even up to 20% if really I have strong conviction on the product and on the growth, and it matches my macro, let's say, predictions of which sector will perform. If it happens to be in the right sector at the right time, I can even go 20% in it, but I usually like to have between 5 and 10% for exposure to every stock. And then, of course, there are some speculative bets. You need to add a bit of spice in your couscous to make it tasty. At least this is what we do in Morocco. So, for example, today I opened a very small position. I almost never open a position under 2 or 3% exposure, but today I opened a position that is of barely 0.35%, so 0.3, 0.4%. It's in a German battery maker called Varta. It produces batteries and it has deals with car makers, but it's swamped in a lot of troubles with its creditors. The previous CFO resigned, and today they announced a new CFO. So I decided to jump in, but only with 0.3% exposure because I think this new CFO could change things around. At least there is that potential. Worst case scenario, my downside is only 0.3%. Right? I cannot go under a value of $0. So that's my worst case scenario. The best case scenario, I do 10x, 100x, maybe even on the stock, right? It's not probable that I will do 10 or 100x. The probability is very low, but a 0.3% downside is nothing. It's nothing. So I decided to put 0.3% in that stock. So it's also in those terms you need to think in terms of financials and valuation on one side, and on the other side, what is your maximum downside in a position, right? So this is how stocks work, but crypto is completely different. And I think Timothy's very well positioned here to discuss how to pick cryptos, because I know a lot of our listeners, they also buy cryptos. Timothy, if you want to go ahead, maybe to cover the crypto part. How do you
Yes.
manage risk in crypto?
Or
Yeah,
just
yeah,
how
yeah.
you manage risk in your
In
investing
general.
all throughout,
Yeah.
Yeah, so for me, stocks crypto is totally different. Like Akim saying, stocks, I look at the valuation, I calculate the valuation, I see if it's undervalued. But I know in advance how much I want to allocate. So let's say I want to allocate 5% to that stock. Let's say Nvidia. I heard it's a good stock.
Yeah,
And
me too.
then it drops to one level of support. So I look at the price chart. It drops to one level of support, and that's when I buy. But I draw 5 levels on the chart, like 5 levels I want to buy a stock. And so whenever Nvidia drops more, I will buy a second layer, 2% of Nvidia, 3% if it drops even more, until I have my 5%. And at the end of the road, I don't have cash anymore to invest in Nvidia. If it drops more, I will just manage my risk. I won't go higher. I won't invest more than I have, and I will just let it ride and just wait for it to recover. So that's for stocks, no stop loss. For crypto, I look at a chart and I look at how the trend is going. You want to buy altcoins that are in uptrends, because if you're buying an altcoin in a downtrend, you never know when it's gonna stop dropping. So you have to put the odds in your favor. Like Nestor, you said, you have to weigh the probabilities. Is it gonna have strength, continue higher? Then you can, once it's bouncing off a certain level, for me, I'm always watching the 200 moving average. You can add the indicator on TradingView easily. But each time it drops to the 200 moving average, I know here is the place where buyers have to step in. And that's also when I put 2-3% of my portfolio in one altcoin. And then if it can bounce, I will just ride it further. If it drops, I make sure I manage the risk. I put a stop loss and I have like a mental stop loss where I don't want to keep holding that back. And that's usually below the 200 moving average for me personally. So that's the difference.
Okay, I wanna throw a question in the pit for a second.
I also had a question actually, because
Okay,
we do
go with your question and I'll ask it.
we do talk a lot about about buying, right? But portfolio management, portfolio allocation, risk management is not only about buying, right? It's also about selling, knowing when to exit, and this is something we didn't really touch on it yet, right? So I don't know if Nestor, you wanted to ask something else.
Okay. Let me ask this question because it's directly related to this. But then I have another question for the conversation we're about to have. So the question is simple. Akim and Timothy, stop loss, yes or no? Don't explain to me why, whether you put it or not.
No stop loss, no take profit, no automatic one. No. I don't
Wow.
like when I don't like when an app makes a decision for me. I don't care if a price is hit by the chart, and no, I want to be the one making the decision after reading and seeing what are the news, did the fundamentals change. So no stop loss, no take profit at all, never.
Timothy.
For stocks, no. For crypto, yes.
Okay, you see, important because crypto's 24 hours. You don't get the gap up. You don't get the
I'm
gap up because
sleeping.
yeah. Is the truth. Is the
Yeah.
truth.
No,
For
but
me, I don't put them.
even crypto never, because you could have some stupid news. I don't know, like imagine the White House Instagram account from the White House, from
Gets
the US
hacked.
White House, get hacked and says the Russians are nuking us, right? It could be true, right? So you can imagine the panic. And this could happen during the night.
But
And
there could
Bitcoin
be
is the first to
strategies.
move.
There could be strategies to do that. You set up your stop loss, but then at 10% lower, you set up your buy order. So it's interesting. I think there's a use case. But I don't use them myself. I'm against them. I'm against them because, like you, I want to be able to know why the market is freaking out. For example, in the DeepSeek saga, the next week was me figuring out everything I didn't know about the Chinese and AI. All of it. And then you start realizing, no, the Chinese, they have the GPUs. They just bring them from Singapore. Yeah. There's still cocaine. There's still cocaine in the States, and it's illegal. You know what I mean? Like, they have their tips. But yes, cool. Okay, so now let's talk. So take profits, Akim. What is your view on take profits? Because for me, it's usually I have targets, but those targets grow as the company continues to produce well. So for example, my target right now to sell NVIDIA is 160. But that's what I think potentially the high range of the value of the stock is. Potentially 150 is fairly priced because we have grown. Every quarter the company produces
Nestor,
more, it
I'm
increases.
sorry, but it makes no sense what you just said.
What do you mean? What do you mean?
You said the value is at 150 or 160. Is that today, or is that what if the stock hits 150, 160 3 months from now? 3 months from now is 3 months of growth.
Exactly. So then, but then my price target will
So
go
your
up.
price has to move again.
Of course. I think that 160 is fairly valued for NVIDIA.
So what's the point having a price target then if it moves all the time?
Because you're not buying. I'm not buying a house that does nothing. I'm buying an asset that continues to increase. But The thing is like, so let's say this is the line for the price, what I think the price should be doing as time goes by. If the stock goes higher than that price, it's
Yeah,
overvalued.
what do you do then in that
Overvalued. Then you
case?
start repositioning. You can get out of 5%, 10%, 20% of your position, and then buy when it's, because you're gonna get that volatility. The more it moves, the more percentage profit you can get out of an asset, the more volatility is likely to have. Bitcoin is one of those examples. Nvidia is one of those examples. We're seeing massive moves in Nvidia because the price discovery of the stock, people still don't know what they're buying. So the price is something that is moving as time goes by. You know, it's like from this quarter to this quarter, if they meet my expectations in their revenue and their earnings, the value of the stock should be this. And that's how I think hedge funds figure it out. You know what I mean? Because like Amazon is not the same company that it was 10 years ago. But if they offer me the price of 10 years ago of the stock today, I would have sold it. You know? Same with Nvidia. If you give me Nvidia at 2000 or, okay, oh, sorry, 200 because of the split, Nvidia is not growing that fast, right? The future growth that I see in the stock is not that. So that's where potentially I think is like there are chances where you can actually get in and get out. But again, this is with my short term part of my portfolio, which is like around 20%. Because I don't wanna miss a potential rally like crazy because the market can be irrational longer than I can be right.
Greedy. Then you
For
can be
sure.
greedy even, huh? Longer than
Of
you can
course.
be greedy.
Of course, you
Yeah.
know?
Is so my way of seeing is a little bit different. Huh? So, but everyone has his own way of seeing. Uh, for me, when I don't really care if a stock I currently own becomes overvalued based on the valuation today. What I try to see is based on the valuation in the next 12 months, whether it is overvalued today. So I try to always look, 12 months from now, whether the stock price will be higher than it is now or not. So a stock can be overvalued today at the stock price today based on its earnings today. But when a company has really high growth potential, maybe that overvaluation today, for example, TSM by all metrics is overvalued today, but it does have a potential to be at least 20% higher a year from now because the earnings could justify the strong valuation, right? So that's why I was telling you for the price targets, maybe, I don't know, I don't like to have price targets. I just like to see every quarter I do a review of my portfolio at the end of every quarter, and I see whether there is still at least 25% upside on a conservative basis. This means that if the company grows at a normal growth rate in relation to the growth rate it had in the last 5-10 years, if there is at least 20-25% upside in a base case, in a very conservative base case. If the answer is yes, I keep it. I don't sell. I don't even sell a bit. I keep it. If the answer is no, I may completely exit or at least exit a good portion if I see the momentum at least is still there and there could be some upside surprises. And then this money I reallocate in other stocks that in my opinion have more upside depending on valuation and depending on number of different factors. So that's for stocks. But then for cryptos, there I do have a price target. My price target currently, at least because we are supposed to be in a bull cycle this year. Last few weeks, a lot of people capitulated and gave up, but I think, this is part of the bull cycle. For a lot of cryptos, my targets are not their previous all-time highs from 4 years ago, but kind of close to them for a lot of the cryptos that I have. But for crypto, I think you have to use charts mostly. Charts, and you try to see with the market cap, whether it's kind of in line with similar projects. But yeah, for crypto, I think you cannot use a lot more than charts to decide when to exit. But for cryptos, in any case, for me, is short term. So at the end of this year, I'm completely out of crypto. I want to have it just for this year because it's where we are in the crypto cycle. And if the same happens as 4 years ago and 8 years ago, we're supposed to have a nice altcoin season this year. I do think we need the Fed to give a green light for the altcoin season to happen. Maybe inflation to tick a bit down, but that's a topic for another day. What about you, Timothy? Do you see it the same way? For crypto, do you have also a different way for stocks? For both,
No,
yeah.
so for stocks, it's quite easy. Let's say looking at Meta, it had 20 days green in a row. 20 days in a row, it was pushing green candles, but it's still
That's crazy.
decently
Insane.
overvalued. Not like 50% overvalued, but based on my calculation, 10%. So 10% for me is still okay. If, for example, let's say Palantir rising from below $10 to now 120. I mean, my valuation for Palantir is around 40, and now it's triple the amount. So yes, I'm gonna take profits on that stock.
By the way, Meta stock is down 2% today. I'm sure Nestor was checking that. It's down 2% today.
No, I need to
Meta.
sell my
Huh?
SMCI
So
calls. I need to
it's
make.
the end.
I need to sell my SMCI calls. It's
So
at
it's
60 now. It's too much.
looks like it's the end of the running streak. Yeah. What about crypto? Sorry.
Yes, crypto. I look at the chart, of course. Crypto is more like trades, and I think that if you're a trader, you have to pay yourself. So whenever an altcoin or a crypto it goes up, it doubles in a few weeks, few months. At least take off 25%, and that's the reward you get for that good idea you had to enter that trade, and then you still have some ammo left to let it run.
And do you do any gradual selling, like you do gradual buying? You mentioned that when a stock drops, from certain thresholds, you buy a bit more and a bit more, 2% more. Do you also do gradual selling, or you like to exit at once a position, a specific position?
No, so Palantir, I sold 1% when it was at 80. Then I sold another percent when it was at $100. And then I sold another 1% when it was at 120, for example. So I'm also gradually selling the stock, but I
Gradually
also
selling.
want to leave a bit of ammo in case it keeps running, because we're now in the AI boom, and I think Palantir is an important player within the space. So it's like your lottery ticket in case it keeps running. So I don't want to be completely out.
Yes, it makes sense because, something that people need to be aware is a small handful of winners make the most of your returns in the long term. Sometimes one single stock can make really the most of its returns when it's, a 10 bagger or even a 100 bagger. So it's really important to be careful with your winners, not to try to sell them and then to invest in your losers. So you have to be, it's part of, I think it's the hardest part actually of portfolio
The
allocation
thing is, people
is,
always want like a 10 bagger, and whenever their stock doubles, they're already completely out. And then
yeah,
how can you ever have a 10 bagger if you sell after one 2x? So you have to have the stomach to hold also to the upside.
absolutely. And you need to also have the patience because the 10 bagger, usually you don't do it in a few months. It can take a decade even to have that 10 bagger.
GameStop?
Nvidia.
No, Palantir was in 3 years.
Okay, so let's head to the last little bit. Let's try to keep this one quick, but it's gonna be an interesting one for sure.
Nestor,
Tell
I'm
me.
noticing you avoided the question about when to exit.
So usually it depends on the kind of trade that I'm doing, right? So if again, so if I have a price target for a long-term position, I have an idea of what the price is going to be doing, and I wait for those prices to come in. But for short-term trades, also I'm expecting for catalysts. So usually I have a catalyst in mind, something that will make the stock go in and out, or pump the stock, or maybe drop the stop, which in some cases, for example, I'll explain the SMCI trade right now. The SMCI trade for me was the stock got really bad news, one after the other one, and it just bad news, bad news, bad news. Everybody sell, sell, sell. The selling sentiment was just way too much. And then all of a sudden it's like, okay, I don't think that the selling sentiment in this case is very warranted. The company is telling you that they're okay. the financials are show like as long as you believe the financials are strong. So there's definitely a room for upside. So you wait for the stock to fall, and you don't try to catch the falling knife, but you wait until the stock sort of balances, and then we enter that price discovery area, right? We enter that price discovery area where the stock starts moving sideways for a little bit, and then all of a sudden you say, okay, now I see that there is actually maybe the good news cycle is starting to come in. And what do you see in the news cycle? You pay attention to the earnings call, and in the earnings call they say, hey, we're not lying. The people from the auditors are telling us we haven't done anything wrong. We're just late with the numbers. And
Yeah,
then if you
but
believe those,
that's for
you
the
wait.
buying, and then you
No,
buy.
no, no. But then selling is all of a sudden when the whole market now gets all of this information, we have reached peak spread of the news, I want to call it. But it's like when now the whole market knows, the news cycle has picked it up, everybody's now talking about this, you start feeling that sentiment that the
Mm.
people just keep buying, and they start feeling that sense of fear of missing out. That's when I try to X my position, because I think that trade, like the knowledge that I had at the beginning, is now shared by everybody has placed their position. So for example, today SMCI is sitting at 60. And now it's selling off into the open. Why is it selling off into the open? Because likely is many people don't want to, like many people are trying to buy. They're saying, oh, I'm going to miss SMCI. I knew I was right. All of that stuff. And a lot of people are holding the stock from 100. So you have to understand there's some selling pressures and opening pressures. So do I think SMCI could go higher? Maybe. I think my target for SMCI was 50. Right now it's 16 at 60. It's over the threshold. I want to sell my position, which is what I'm trying to do right now.
Quick question then.
So for me, it's like it depends on the trade, but for my long-term positioning is understanding I have a price target. If it goes way above my price target, I am willing to trim my position down, and I can always re-enter at a later date. I'm just taking a little bit of cash off the table, depending how much risk I'm taking. For example, on options, usually I go with 2 contracts, right? So one of my contracts will be like, so let's say I'm making 100% on the trade, I can sell one of my contracts and pretty much have a risk-free trade. So that's also a way that you can always take money off the table, like take out your initial capital and only leave the remainder, which is your profit. And that allows you to then potentially like maybe re-enter again. You can always buy the stock. It's a liquid market. So that's something I take into consideration. But that's a little bit of my trading mentality, in that sense, So yes, that I would say, But yeah, it changes depending on how the trade goes and what the reason I enter defines the reason I exit. I would say that. Yeah.
Interesting.
But yeah, right now I'm trying to get out. I lost. I missed the 60. I missed that 60.
Just say the question and we go on.
Okay, so I let you. So the third one, and this segment is just kind of getting a little bit of understanding. It's like hedging. When do you hedge? Because right now we've had a lot of market volatility. Something that you pay attention. Do you short your markets? Because that's something that they mentioned on the eToro conference. They were like, oh, shorting, and how do you use shorting? Do you use that at all in your trading or investing?
Shorting?
Yeah, shorting, hedging. Like, how do you navigate volatility markets? Do you just buy more? You double down?
Yeah, I usually like to buy more, so I buy more. I don't like to hedge because usually, people don't make much money with the hedging tools. When I see other investors and their portfolios and I see what they use for hedging, it's usually like down 90%. So I don't hedge. I only shorted once in my lifetime. And it was GameStop. I made a lot of profit, to be honest, last year on that. This was one time I shorted, but maybe it was more for the publicity because everyone got crazy in the eToro feed when I announced that I was shorting GameStop. But I don't like to short in general. I don't hedge. I buy more. Yeah, I buy more when something is cheap. I buy more. Like Microsoft, I find it very cheap now. It's very interesting, very attractive valuation. Also in terms of chart, we're at the line of support. I really bought a lot of Microsoft. I didn't have any position in Microsoft because I felt that, it grows a bit less fast than the other Mag 6, but the current valuation is super attractive. So I buy more, yeah.
Oh, Timothy.
Since I'm in Belgium, eToro has blocked all Belgium accounts to short, so I'm not able to short. But I'm also not planning to short if it's possible on my account. Just because, like Akim said, you lose a lot of money shorting. You have to be like locked in. Make sure you wait. My baby's here.
Yeah. And
Welcome to a newest
hello.
member of Market Buzz.
Hello. Yeah, there are fees when you short, and the market can stay rational longer than you can stay solvent, right? So I think that's what Timothy was trying to
And I
say.
buy more, of course. I buy more, just like you, Akim.
For me, I've started putting my feet on the water. But the problem with shorting is that you have to both be right and you have to get it right quickly. Because
Plus the
otherwise it
timing.
costs you
Yeah,
money. You
yeah,
know, like
yeah,
that's
yeah.
where SMCI, when I saw SMCI at 120, I wanted to short it. I was like, this is unsustainable. And I shorted it and I lost money. Even though it went down to 20, I shorted it and like I lost money. And the thing was because I didn't allow my trade enough time to breathe. I did it with options. I bought some puts and I bought some puts. And then, yeah, I'm so mad.
If you
But
had to short one stock, which one would it be now?
right now,
If
I'm
you
looking at
had to,
Carvana. I don't trust the Carvana rally. I really don't trust the Carvana rally at all. And
why?
SMCI is starting to get to levels that if it gets to
Why?
100 again, I'm shorting it. It's
Yeah,
it's
but
not worth 100.
why for Carvana?
Because Carvana had like they did a bunch of like financial tricks in order to kind of like get away from paying a bunch of their debtors, like and it's just I don't trust them. You know what I mean? Like the loan car market in the United States is a bubble. It's everybody buying cars and everybody making money with those cars and everybody's in debt. And it's like it's so easy to get a car loan in America. And I just don't think that can be sustained for longer. But in America, you need a car. It's a must. So it's like if I'm looking at that as a short and sitting at the levels that it's sitting right now, I think it's over $200. I just don't see them. I like, am I gonna be willing to put in the money? No, I haven't done it because like it likes to go crazy up too.
Mm-hmm.
But that's a company that I'm paying attention to for sure. I don't trust it.
If I can give my pick for shorting, Timothy's not gonna like that, but I'm not gonna do it. But if I had to short one stock, it would be Palantir. The reason being, if you look at the
Also.
valuation right now, it's valued at 2 centuries worth of forward earnings. This is insane, and personally, I like to short stocks like that where retail is just crazy and there's this crazy greed. The hardest part is, of course, the timing because there's enough individual investors to keep jumping in every day. But when the panic starts, it usually lasts for a long time. And I think when the panic starts is a good time to short. And how do you know the panic starts is when you have a lot of people posting. And this is why I like eToro because it's social trading, so you can really see the sentiment of people. And when people start writing, "What the hell is going on today?" and some other people hold the line, buy the diff. It's like crazy, you feel really in a war zone.
The
So this is
eToro
when
army.
Yeah.
when it's a good time to short.
It's a good barometer. It's a good barometer for sure.
But my criteria is that the valuation should be at least 1 century worth of earnings. In case of Palantir, you need to wait 2 centuries for the earnings to cover. For forward earnings, I'm not even using the trailing earnings. This would be 4 centuries. Anyway, we're talking centuries in any case.
Yeah. I mean, the thing is sometimes you get companies that are able to meet those growth expectations, and then you evaluate them, and then by the valuation that you never put money in them, but then they're the 100, 200x. Again, Palantir is tricky. Do I think they're overvalued? Yes, because a lot of their money is made through the loans that they've done, and they make money through interest. So, do I think they're overvalued? Yes, but I could be wrong. You know what I
It's a
mean? I
good
could be wrong.
company. It's not a bad company. It's not a junk company, right? So a lot of short sellers, they like to short junk companies, bad companies. But I think it's more exciting to short this kind of companies that are good. GameStop is not junk neither. They generate revenue. They have some kind of growth path ahead, that is possible. But it's just like you can feel it on the eToro feed, the sentiment of retail when it's time to short. But again, I'm not going to short Palantir. Don't worry, Timothy.
Oh, I completely understand because like I'm
Timothy will let
holding
you
it in
borrow
my
the shares.
portfolio.
Which one
So
will?
So, Timothy.
What about you, Timothy? Shorting candidate.
I'm not going to short, but I think Solana will be a beautiful short. Like if because now there's a lot of drama for the
What?
meme blockchain. Yeah.
You
So
are
you had
crazy, man.
You want a controversy? You get it here first.
Wait, Nestor, you need to cut this part, and post it. This is crazy, man. Don't you have a long position in Solana, or you had it recently?
Yeah, and I'm watching one key level as my last level, and if it loses, I'm out.
But you have a long position in Solana, and you're saying you would short it.
If it
Am I
loses
understanding
that
you right?
position, if it loses that position, yes. If it loses that level, like the 200
Yeah,
moving
yeah.
average, which I'm saying it's already below it. So if it can't reclaim that key level, I think it's over and out for Solana this cycle.
And if it
And it has
does
to do with
reclaim,
it.
if it
If it
does
does
reclaim, it's super
reclaim, I will
bullish
just,
or not,
yeah, the cycle continues.
right?
Let's write it on. But you have to have a stop somewhere, and then when it loses that level, that's also a level where you think, okay, there's a lot of downside possible because it has been going up in a straight line.
Nestor, we're gonna have the Solana army in the comment section. I can feel it.
That'd be great. That's a short. That short's going on eToro first.
You should make it the title of the episode. Timothy says to short Solana.
Oh man, no, great. I think anything else you guys want to add before we cut it? I think it was a good episode.
It was fantastic.
Yeah.
Perfect.
Oh, that cost me so much money. That cost me so much money.
The episode.
Yeah, the episode.
Because of
I couldn't get out. I couldn't get out. That's I'm
let's
losing
see.
on the Intel. Well, no, like it's not the episode, but I mean Intel is way down. My position on Intel.
But you bought
I'm
it
losing.
when? You bought it
No, I'm
early.
still making money. I'm still making money on it. It's good, but
No,
I
but
had a
look,
chance.
the
I had a chance.
SMCI is getting back to 60. Just watch. It's gonna go back.
I think so. I think so too. I think it was resistance early morning. A lot of people selling from yesterday. You know, you bought. You're making what? 10, 6, 7% in a day. More than happy to sell.
Yeah, I think it's a lot of take profits that were hit. When it hit 60 at market open, a lot of take profits were triggered. But
The
people will
Intel
buy.
one is the one that has me worried because there's like everybody's starting to come out saying, no, we're not looking to buy. The Intel one, I got lucky. My theory was that they were gonna get a CEO by mid-February, and they still haven't figured out the CEO. But I got lucky with the potential purchase, and there was some rumor that apparently the 2 nanometer chips are better than the TSMCs.
Hmm.
So if that's true, Nvidia played it right. Sorry, Intel played it right for the future. So we'll see.